Welcome to my channel. I am going to walk you through the process of valuing 3 clothing retailers and analyzing their financial ratios. Comment if you have questions. I respond to every comment. Subscribe if you want to see me value more companies. Become a member of the channel and I could do a more in-depth valuation on the ticker of your choice. See the link in the description. The first company we're going to look at is Gap. This is a clothing retailer. The main stores it operates are Gap, Banana Republic, and Old Navy. Let's get started with the model. They're a mid-cap company. They have a market cap of $6.5 billion. They're trading at about $17 a share. And to get the shares outstanding, that's market cap divided by stock price, gives you shares outstanding, 387 million. We're going to need this number later when we calculate the value of the company. Let's look at the financials. So free cash flow is how you value a company. You estimate the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive free cash flow each year. It is declining, but at least it's positive and fairly healthy. In 2019, they had net income of $1 billion. But free cash flow of $676 million. When free cash flow is a lot less than net income, that raises a red flag for me. And I looked onto their cash flow statement, and a lot of it is inventory. So companies like this purchase lots of inventory. So when you buy inventory, it depletes your cash. But if you don't use the inventory till the following quarter, it just sits on your balance sheet. Net income is total revenue minus total expenses, so it's your profit and loss for the year. So they do have positive net income each year, although it drops in 2020, but it looks pretty good. Their revenue looks okay, it's pretty consistent, it doesn't grow too much, and their margins are pretty low, only 2% in 2020. Let's look at the capital structure. They have $1.2 billion of debt. They pay 6% interest on their debt, and the cost of debt is 4%. To get cost of debt, it's interest rate times 1 minus the effective tax rate. And their capital structure is 27% debt, which means 73% equity. Cost of equity is about 15%. The way you figure out cost of equity, we use the beta in the capital asset pricing model. The beta is how volatile the stock is relative to the market, and they have a beta of 1.64. So the stock is a bit more volatile than the market. Their WACC is 12%, which is a blend of the cost of debt and cost of equity, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $6.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $6.2 billion. We divide that by 387 million shares. We get a calculated stock price of $16.08. They're trading at $16.79, so they're trading at a 4% premium. So it's a sell according to the model. I'm $16.08, Simply Wall Street's $11.63, so they're saying the stock is overvalued. I think they're expecting this company to take a big hit during coronavirus. Let's see where the stock has been trading at the past few years. So it looks like it was in the mid to low 30s for a while, but then it's dropped a lot. It went way down to maybe $9 or $10. It's come back up, but it seems like it could be a good value, but it is a little risky at this time. Let's look at the financial ratios. They have a decent PE. The market median is 16. The average in the market is 23.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 18.5. So investors are paying $18.50 for $1 of earnings. They have a really good price to sales ratio. The median is 1.8. The average is 5.1. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 0.4. So investors are paying 40 cents for $1 of revenue. Price to book is also pretty good. The median in the market's 2.3, the average is 5.4. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 2.0, so investors are paying $2 for $1 book value. Remember, equity is total assets minus total liabilities on the balance sheet. Good interest coverage ratio, the median is 3.9, the average is 13.1. Interest coverage ratio is EBIT over interest expense. I like to see above 2.0, they're at 7.6, so they can easily cover their interest payments. ROE is a little low. The median is 12%, the average is 9%. ROE is net income over equity. I like to see above 20%, they're only at 11%. Current ratio is good. The median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2, they're at 1.4. The best way to look at ratios is to compare them to similar companies. I've done videos on L Brands, Lululemon, and ROST stores, all in the same industry as Gap. And if Gap has a number in red, they're worse than the average. They have a number in green, they're better than the average. So they are better in price to earnings, price to sales, and price to book. Current ratio is fine. ROE, they are worse than the average at 11%. Average is 31%. They're a little better in debt at 27%. Average is 34%. They're the smallest of the four companies in terms of market cap at $6.5 billion. And they don't pay a dividend like every other company in the industry. So to summarize, I have them trading at about intrinsic value. Their ratios look pretty decent and their financials are okay. The second company we're going to look at is L Brands. This is a fashion retailer. Its main stores are Victoria's Secret and Bath & Body Works. Let's get started with the model. They have a market cap of $8.4 billion, so they're a mid-cap company. They're trading at $30 a share, and they have 279 million shares outstanding. Their free cash flow looks pretty good. It's consistent and healthy and positive, which is great. The net income is okay, although in 2020 it's negative. The reason for the negative net income is because the company took a $725 million impairment charge on its struggling brand, Victoria's Secret. Their revenue looks pretty consistent. It's not really growing. It's sitting around the same levels each year. Let's look at the capital structure. $5.5 billion of debt. Interest rate on debt is 6.8%. Cost of debt is 5.1%. They're 100% debt. They have no equity in their capital structure because their liabilities are greater than their assets. That's generally not a good sign when investing in a company. Their WACC is 5.12%. That's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's $2.4 billion. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $4.2 billion. We divide that by 279 million shares, and we get a calculated stock price of $15. They're trading at $30, so they're trading at 102% premium. It's a strong sell according to the model. Simply Wall Street has them valued at $18.41, so in the same range as me. Let's see where the stock has been trading at the past few years. So it looks like it's been coming down little by little every year. So it's sitting at a fairly low point for the stock since it was over $100 at one point. So it's a little risky when you invest in a company with negative equity. Just because a company has negative equity doesn't mean it's a bad value. Let's look at the financial ratios. Negative PE because they have negative net income. Their price to sales is good. That's price of stock over sales per share. I like to see below 2.5. They're at 0.7. They have a negative price to book because they have negative equity. Good interest coverage ratio, that's EBIT over interest expense. I like to see above 2.0. They're at 2.6. And their ROE is negative since they have negative equity, so we can't look at that. The current ratio is good. That's current assets over current liabilities. I like to see between 1.2 and 2. They're at 1.4. And the best way to look at ratios is to compare them to similar companies. I've done videos on Gap, Lululemon, and ROST stores, all in the same industry as L Brands. And if L has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they are worse than the average in pretty much everything except price to sales. To summarize, I have them trading at 100% premium. Their ratios look pretty bad compared to their competitors. Although they have positive free cash flow each year, so that's a really good sign. They do have negative equity, so it could go either way on this investment. The next company we're going to look at is ROST Stores. ROST is a chain of discount department stores. It has 1,500 stores in 37 states. Let's get started with the model. They're a large cap company. They're 33 billion market cap. They're trading at $92 a share, and they have 355 million shares outstanding. Their financials look really good. Everything's positive, consistent, so we should get a good value for this company. Let's look at their capital structure. $313 million of debt. They pay 3.1% interest on their debt, and the cost of debt is 2.4%. The weight of debt is only 9%. That means they have 91% equity, and their cost of equity is 8%. To figure that out, we need the beta. That's how volatile the stock is, and they have a beta of 0.75, so the stock is less volatile than the market. And their WACC, which is a blend of the cost of debt and cost of equity, is 7.6%. That's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $38 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $35 billion. We divide that by 355 million shares. We get a calculated stock price of $98. They're trading at $92, so they're trading at a 6% discount. So it's a buy according to the model. Simply Wall Street has them at $73, so they're saying the stock is overvalued. I think they're expecting this company to be struggling in the next few quarters. Let's see where the stock has been trading at the past few years. So it looks like it's only been going up and up until coronavirus hit, and then took a big dive. It's come up a little bit, but it's still well below its high pre-corona. Let's look at the financial ratios. They have a weak PE, that's stock price over earnings per share. I like to see below 15, they're at 19.7. They have a good price of sales, that's stock price over sales per share. I like to see below 2.5, they're at 2.0. They have a weak price to book, that's stock price over book value per share. I like to see below 3.5. Good interest coverage ratio, that's EBIT over interest expense. They don't have much debt, so they can easily cover their interest payments. Really good ROE, that's net income over equity. I like to see above 20%. They're at 49%. So they provide a great value to the equity holders. Current ratio is also really good. That's current assets over current liabilities. I like to see between 1.2 and 2. They're at 1.3. The best way to look at ratios to compare them to similar companies, I've done videos on Gap, L Brands, and Lululemon, all in the same industry as ROST. And if ROST has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they are a little worse in price to earnings. They are better in price to sales, worse in price to book. They're doing fine in current ratio. They have the best ROE of all the companies. They have a lot less debt than the average company in the industry. Their market cap is also bigger at $33 billion. They're the second biggest company of the 4. And they don't pay a dividend like the other companies. So to summarize, I have them trading at a 6% discount. Their ratios are pretty good, but their financials are amazing. Let me know what you think of the video. Leave a comment. I reply to all comments. Subscribe if you want to see me value more companies. And become a member, and I could do a full valuation of the ticker of your choice. Thanks for watching.